All right, so are you ready to dive in? Today we're going to try to answer a question that I think is on a lot of investors' minds right now.
Yeah.
Can the stock market keep rising, even with interest rates going up?
It's really the big question of the moment, right? Conventional wisdom says rising rates are bad for stocks, but we've been seeing something different lately.
Yeah, I mean, that's why we're looking at this analysis by Alec Young at mapsignals.com.
Right.
He's basically saying high interest rates are not going to kill this rally.
It is a bold statement, but he's got some data to back it up. Since late 2023, the S&P 500 has gone up something like 40%,
Wow.
even while rates have been rising.
Okay, so I have to admit, I've always thought that higher interest rates were bad for the stock market.
Yeah.
I mean, aren't companies going to hesitate to invest and grow if it costs them more to borrow money?
Well, yeah, that's the traditional thinking for sure.
Right.
Higher interest rates make it more expensive for companies to borrow, which can impact their profits, and make their stocks less attractive.
Right.
Plus, if you can get a decent return on something safer like bonds, why take the risk in the stock market?
Yeah, that makes sense.
So the thinking goes that money would flow out of stocks and into bonds.
Right. But Young's analysis is sort of throwing a wrench into that theory, isn't it?
Yeah, it really is.
Yeah.
I think one of the most interesting points he makes is about the historical relationship between the 10-year Treasury yield and the S&P 500. The 10-year Treasury yield is basically the interest rate that the U.S. government pays on its 10-year bonds. It's kind of a benchmark.
Okay, so how do those two things, the 10-year yield and the stock market, how do those usually relate to each other?
You would think that there would be a strong correlation, right?
Right, yeah.
But since 1965, the correlation has been pretty much zero.
Zero. So they don't really move together at all in any predictable way?
No, not really.
Okay.
It means that historically, the stock market hasn't consistently gone up or down because of changes in the 10-year yield. They've kind of done their own thing.
But wait a minute. Haven't rates been climbing steadily for a while now?
Yeah.
And hasn't the market been going up too?
You got it. Go back to 2020.
Okay.
The 10-year Treasury yield hit like 0.5%, which was super low.
Wow.
And it's been climbing since then, but guess what? The S&P 500 has actually doubled during that same period.
Huh. That's really interesting.
Yeah.
It makes you wonder if this time really is different. I
Yeah.
mean, I've always assumed that rising rates meant get out of stocks.
It really challenges what we think we know, right?
Yeah.
And that's where Young's analysis gets really interesting.
Yeah.
Because he's suggesting that other factors are maybe outweighing that potential negative impact of those rising rates.
Okay, I'm hooked now.
Okay.
What are these other factors that we should be paying attention to?
So Young focuses on one main thing, credit spreads.
Okay.
Think of it this way. You go to a bank to get a loan.
Okay.
The interest rate you get depends on how risky the bank thinks you are right.
Right. If you have bad credit, you're going to pay a higher rate.
Exactly. And it's the same for companies. They
Uh-huh.
have to pay a little extra to borrow money above whatever rate the U.S. government pays.
Right.
And that extra is called the credit spread.
Okay, that makes sense.
So the bigger that spread is, the riskier the company looks to lenders.
Got it.
And here's why this is important for the stock market.
Okay.
When those credit spreads are tight, meaning that extra they're paying is small, that can be a sign that people are confident in the economy.
Right, because if lenders are willing to loan money to companies at rates that are close to what the U.S. government pays, it means they're pretty optimistic about those companies' ability to repay.
Yeah, exactly.
Okay.
They're basically saying, we believe in these companies, we think they're going to do well,
Okay.
and that confidence can be good news for the whole stock market.
So what are credit spreads telling us right now? Are lenders feeling good?
So Young looks at what are called investment-grade credit spreads.
Okay.
These are for those big blue-chip companies,
Right.
the ones that are well-established. And you know what? They're near record lows right now.
So those big companies are getting loans at super low rates.
Pretty much.
That does sound like people have confidence in them.
They're only paying about 80 basis points above similar U.S. Treasury bonds,
Okay.
which is way below the historical average of 132 basis points.
So I have to admit, I don't really know what a basis point is, but it sounds like a good thing that it's low.
Think of it this way. 1 basis point equals 0.01%.
Okay.
So 80 basis points is 0.80%.
Okay.
It's just a way to measure those small differences in interest rates.
Okay, that makes sense.
Yeah,
So lenders are basically throwing money at these big companies.
you could say that.
It sounds like they're feeling pretty optimistic about the future.
Yeah, and historically, when those investment-grade credit spreads have dropped below 1%, the S&P 500 has done really well.
Interesting.
We're talking average gains of almost 12% the following year.
Wow.
compared to just 6.6% when
Yeah,
those spreads are higher.
that's a big difference.
Yeah, and not only that, but the market has also been less volatile during those times of tight spreads,
Okay.
so less of those really big drops.
So it sounds like credit spreads are a much more nuanced indicator than just interest rates alone.
Yeah.
What else should we be thinking about?
Well, Young brings up another interesting point. Investor sentiment.
Oh, yeah. Everybody loves to talk about market sentiment.
Wait, is it fear or greed driving the market today?
Exactly.
But Young points to this specific survey.
Okay.
It's called the American Association of Individual Investors Sentiment Survey,
Okay.
or AAII.
Got it.
And this survey basically asks individual investors if they're bullish, bearish, or neutral in the market.
So it's like a temperature check for everyday investors.
Exactly.
Right.
How are they feeling about stocks right now? And Young points out something really important. Bull markets tend to die on euphoria.
Yeah.
When everyone's just piling into stocks and convinced they can only go up, that's often a sign that things are about to change.
I guess when everyone's already bought in, there's no one left to buy and push those prices higher.
Right, and here's the surprising thing. According to the AAII, we're not even close to euphoria right now.
Really?
Yeah, bears actually outnumber bulls.
Wow. So even though the market has been rallying, people are still feeling pretty pessimistic.
Yeah, and historically, this kind of bearish sentiment has actually been a good sign.
Interesting.
When everyone's feeling gloomy, it can be a good time to buy.
So it's almost like a buy signal.
Potentially, yeah.
Wow.
Young says that the S&P 500 has averaged a 6% gain in the 6 months after those super bearish readings.
This is all really interesting.
Yeah.
So far, we've got rising interest rates, tight credit spreads, and surprisingly bearish investor sentiment.
It's a lot to think about.
Yeah, it's a mixed bag.
Right.
What does all of this mean for us, for our portfolios? What should we actually be doing with our investments?
Well, that's where Young gets into some specific recommendations.
Okay.
He says that investors should focus on cyclical sectors.
Cyclical sectors. Remind me what those are again.
Think about industries that do well when the economy is growing.
Okay.
Things like consumer discretionary industrials, materials, and energy.
Okay.
Basically, companies that sell things that people buy more of when they have more money.
So instead of being scared of rising rates,
Mm-hmm.
Young is saying that we should be looking for opportunities in those sectors that benefit from a strong economy.
Exactly. And he's not just talking about those giant, well-known companies either.
Okay.
He sees opportunities across the board.
What does that mean?
You know, small, mid, and large cap companies.
Hold on, market cap. Can you quickly explain that?
Sure. Market cap stands for market capitalization.
Right.
And it's basically the total value of a company's outstanding shares.
Okay.
So a big company with a large market cap is worth way more than a company with a small market cap.
Okay, I got it.
Yeah.
So Young is saying we shouldn't just be focused on those big name companies.
Right.
There might be even more potential for growth in smaller companies that could benefit from a strong economy.
That's the idea. But of course, you always have to remember that any investment strategy has its risks.
Of course.
And it's important to do your own research and think about your own situation before making any decisions.
Absolutely. But Young's analysis definitely gives us a lot to think about. It's challenging some of those things we thought we knew about interest rates in the stock market.
Yeah, it really highlights how important it is to look beyond the headlines
Yeah.
and consider a lot of different factors when you're making investment decisions.
Well said. That brings us to the end of part 1 of our deep dive into interest rates and the stock market.
No?
Join us for part 2, where we'll explore some of the potential risks and catalysts that could shape the market in the coming months. Welcome back to the deep dive. So we've been looking at how the stock market is kind of defying what we thought we knew about rising interest rates.
Yeah.
But I'm thinking, what if this whole analysis is wrong? What if those rates do end up really hurting this rally?
It's a really good question. It's
Wow.
always smart to think about both sides, even when things are going well.
Exactly. So what are some of the risks that could derail this bull market, even if those credit spreads are tight and investors are a little bit cautious?
Well, one big question mark is inflation.
Okay.
What if it turns out to be harder to control than everyone thinks?
So instead of cooling down, prices keep going up.
Yeah.
What would that mean for the market?
Well, if inflation stays high, the Federal Reserve might have to keep raising interest rates
Okay.
more aggressively than they're planning to.
So a steeper climb in rates instead of a gradual increase.
Right, and I think that would make investors nervous.
Yeah, for sure.
And if those higher borrowing costs start to cut into companies' profits, then we could see stock prices drop.
That makes sense. Companies would be dealing with higher costs on one side
Yeah.
and maybe less demand from consumers who are also feeling the pinch from inflation.
Right.
Are there any other potential risks that we should be thinking about?
Another one to watch out for is geopolitical uncertainty.
Ah, yes, the wild card.
Exactly. We can't predict everything that's going to happen in the world.
Right.
And unfortunately, things do happen that can mess up even the best economic forecasts.
Of course.
Things like political instability, trade wars, even another pandemic.
Yeah.
Unforeseen events can really shake things up.
So even if the U.S. economy is strong, some random global event could trigger a downturn.
Yeah, it's definitely a possibility. It's impossible to predict for sure, but it's worth keeping in mind. It's part of the risk of investing.
Okay, so on the risk side, we've got stubborn inflation and that always present threat of something happening on the global stage.
Right.
But let's be optimistic for a minute. Are there any potential catalysts out there that could actually push the market even higher?
Oh, yeah, definitely. And one of the biggest ones is something we've already talked about, the U.S. economy staying strong.
So Young is basically betting on America to keep doing well.
He is. And, there's a lot to be optimistic about.
Okay.
The job market is good, consumer spending is solid, businesses are investing. If these trends continue, it could really push the stock market upward.
A strong economy leads to strong corporate profits, which leads to happy investors,
Right.
and then even more investment.
Yeah.
It's like a positive feedback loop.
Exactly. And another potential catalyst is something that's always exciting, technological innovation.
Oh, yeah. Progress.
We're seeing incredible advancements in areas like artificial intelligence,
Okay.
biotechnology, renewable energy.
It's like those old sci-fi movies are coming true right now.
I know, right?
And those innovations can create entire new industries,
Yeah.
new investment opportunities.
Yeah.
It could drive growth for years to come.
Exactly. Investors are always looking for the next big thing, right? That
Yeah.
company that's going to change everything and make a lot of money.
Okay, so we've got strong economy,
Yeah.
rapid technological advancement as potential catalysts. But I have to ask, even if all of these factors line up perfectly, isn't there always a chance of a market bubble?
Yeah.
Don't those valuations eventually get too high?
That's a question a lot of investors worry about. And the truth is, bubbles are really hard to spot when you're in the middle of them.
So how do we even know if we're in a bubble? What are the warning signs?
There are a few things to look out for.
Okay.
One is prices going up really fast, but not because the companies are actually doing better.
Right.
Another one is excessive speculation and leverage. That's when people are borrowing a lot of money to invest,
Right.
which can magnify both gains and losses.
Like a house of cards.
Exactly. If one little thing goes wrong, the whole thing collapses.
Yeah.
And then, of course, there's that classic warning sign that we've all heard before, the idea that this time is different.
Oh, I've definitely heard that one.
Every time there's a boom, everyone thinks it'll last forever.
Right.
It's human nature to get excited. But, history shows us that what goes up must come down.
So are we in a bubble right now? I have to admit, I'm a little worried.
It's hard to say for sure. But while valuations are high in some areas,
Okay.
there are also signs that investors are being a bit more careful this time.
What do you mean?
Well, remember those bearish investor sentiment readings?
Yeah.
That suggests that people are still a little skeptical.
Okay.
Plus, even though interest rates are rising, they're still historically low.
Right.
And corporate profits are generally good, which helps to support those higher valuations.
Okay, so it's not a definite bubble, but it's something to keep an eye on.
Definitely. I think the important thing is to find that balance
Okay.
between optimism and caution. We don't want to be so scared that we miss opportunities,
Right.
but we also don't want to get caught up in the excitement and forget about the risks.
That's good advice.
Yeah.
So we've talked about the potential risks and catalysts, but I think the real question is, what does all this mean for our portfolios?
Yeah.
How do we use these insights to make better investment decisions?
That's the question everyone wants answered.
Okay.
And unfortunately, there's no easy answer.
Okay.
The best approach for you is going to depend on your goals, your risk tolerance, and your time horizon.
So there's no one-size-fits-all answer.
No. But there are some general principles that can help.
Okay, give me some advice.
First and foremost, diversification.
Okay.
You've probably heard it a million times.
Right.
But it's really important. Don't put all your eggs in one basket.
For the risks.
Exactly. And that means thinking about a mix of different assets, stocks, bonds, real estate, maybe even some alternative investments like commodities.
Right.
If one area of the market does badly, the others can help you out.
So if the stock market goes down, maybe my real estate holdings will go up.
Right.
Or vice versa.
And diversification isn't just about what you own, it's about when you buy it.
Okay.
Instead of trying to time the market, which is really hard,
Yeah.
think about a strategy called dollar cost averaging.
I've heard of that. Can you explain how it works?
It's pretty simple. You invest a fixed amount of money regularly no matter what the market is doing.
Okay.
So up or down, you're always buying, which helps to smooth out those ups and downs.
Okay.
And it can lower your average cost per share over time.
So you're taking the emotion out of it? Exactly. I like that. Any other tips for dealing with this kind of uncertain market?
Stay informed, keep up with the news and what's happening in the market,
Okay.
but don't let the headlines control your decisions.
That's easier said than done.
I know it can be hard. It's easy to get overwhelmed by all the information,
Yeah.
but there are a lot of resources out there that can help you stay informed without getting sucked into the negativity.
Like what? What are your favorite sources?
Well, you can subscribe to good financial publications,
Okay.
listen to podcasts like this one,
Of course.
or follow some trusted analysts and economists on social media.
Okay.
The key is to find sources that are balanced and insightful without all the hype and drama.
Right. So stay diversified, dollar cost average, and stay informed.
Yeah.
Any other words of wisdom before we wrap up?
Just one more, don't be afraid to get professional advice.
Call in the experts.
Exactly.
Mm.
A financial advisor can help you make a plan that fits your goals and your risk tolerance. They can also help you stay disciplined and not make emotional decisions, which is really important when things are volatile.
Yeah. Sometimes it helps to have someone objective in your corner.
For sure.
Yeah.
Especially when it comes to something as important as your financial future.
Welcome back to the deep dive. It's been really interesting looking at how the stock market is doing with these rising interest rates.
Yeah, it's definitely a weird situation. And for this last part, I think it might be good to talk about something Young brings up in his analysis.
Okay.
Sector rotation.
Sector rotation. That sounds a little complicated.
It's not that bad. Think of it like this. Different parts of the economy do better at different times,
Okay.
depending on where we are in the economic cycle.
So like a game of musical chairs, but with industries.
Yeah, I like that.
Yeah.
As the music plays, investors try to figure out which industries are about to get hot
Right.
and which ones are about to cool down.
That makes sense.
Yeah.
So how does this sector rotation idea connect to what we've been talking about?
Well, Young says that as interest rates go up, investors should be careful about where they put their money.
Okay.
He thinks it's a good time to focus on sectors that aren't as affected by those changes in borrowing costs.
Less sensitive.
Right?
So they can still do well even when rates are rising.
Exactly. And the sectors he's talking about are called cyclical sectors.
Okay. Those are the industries that usually do well when the economy is growing, right?
Right. Like consumer discretionary industrials, materials, energy.
So if the economy stays strong, these cyclical sectors can handle the higher rates.
That's the idea. Their earnings are expected to grow enough to make up for those higher borrowing costs.
Okay, so that's the cyclical play. Are there any other areas of the market that Young thinks are worth looking at right now?
He also says to take a closer look at value stocks.
Value stocks.
Yeah, these are companies that are trading for less than they're actually worth.
So it's like finding a bargain.
Yeah, kind of. Like
Right.
finding those companies that the market has maybe overlooked.
Interesting. Value stocks are usually less popular when growth is high and interest rates are low.
Right. But they can do really well when things change.
When investors are being more cautious and looking for good deals.
Exactly. And historically, value stocks have actually done better than growth stocks when rates are going up.
So it sounds like Young is recommending a more cautious approach,
Yeah.
focusing on things that are less sensitive to rate hikes and companies that might be undervalued.
That's a good way to
Mm.
put it. But of course, with any investment strategy, there are risks.
Right. What could go wrong?
Well, one problem with sector rotation is it's hard to know exactly when it's going to happen.
Okay.
It's not always obvious which sectors are about to get hot and which ones are about to cool down.
So you could end up in the wrong sector at the wrong time.
Yeah, it's possible. And even within a sector, there will be winners and losers.
So you can't just blindly invest in a whole sector.
Right. You still have
Yeah.
to do your research and pick the right companies.
Which brings us back to that question we talked about before. What should we be watching in the coming months?
Yeah, what specific things will tell us if Young is right?
Give me the good news first. What are some things that would support his predictions?
Well, one key indicator would be the U.S. economy staying strong.
Okay.
If we see good job growth, strong consumer spending, and companies continuing to make good profits, that would support the idea that cyclical sectors and value stocks can do well.
So we're hoping the U.S. economy keeps doing its thing.
Yeah, exactly.
Yeah.
Another thing to watch is inflation.
Okay.
If prices start to level off and the Fed can slow down those rate hikes, that would be a really good sign for the market.
So the Fed needs to control inflation without hurting the economy too much.
Right, that's the best case scenario. But on the other hand, if inflation stays high or even gets worse, that could be a problem.
Because then the Fed would have to keep raising rates.
Yeah, and maybe even more aggressively. That could even lead to a recession.
And if that happens, those defensive sectors might do better.
Yeah, things like healthcare and consumer staples. Those are the companies that sell things people need even when times are tough.
So we need to be flexible, watch the economy, and adjust our portfolio.
Exactly. This is just a small piece of a very complex market. There
Yeah.
are so many things that could affect stock prices in the coming months.
Which is why it's so important to stay informed, to do our research, and maybe even talk to a financial advisor.
Absolutely.
Well, I feel like I've learned a lot today.
Good. I'm glad.
It's amazing how much is going on behind the scenes.
It's been great talking about this with you. It's always fun to dive into these topics and try to understand what's really happening in the market.
And that's what the deep dive is all about, giving our listeners the knowledge and insights they need to make smart investment decisions.
Until next time, happy investing.
And keep diving deep.